How would people save money if banks stopped paying interest? If banks stopped paying interest, saving money would become less attractive, pushing people to explore alternative methods of preserving and growing their wealth. Traditional savings accounts would lose appeal, and individuals would need to rethink how they manage their finances. This shift could lead to increased investment activity, changes in spending habits, and a greater reliance on non-traditional financial tools. Increased investment in stocks and bonds. Without interest from savings accounts, people would likely turn to the stock market, mutual funds, and bonds to grow their wealth. Stocks offer the potential for higher returns, while government and corporate bonds provide a safer, fixed-income alternative. However, these options come with varying levels of risk, requiring savers to become more financially educated. Greater use of real estate for wealth preservation. Real estate has historically been a reliable way to store and grow wealth. If banks no longer paid interest, many individuals might buy properties to rent out or sell later at a profit. The increased demand for real estate could drive up housing prices, making it harder for first-time buyers but beneficial for investors. Increased popularity of gold, cryptocurrencies, and other assets. Gold, silver, and cryptocurrencies like Bitcoin could become more popular as alternative stores of value. These assets are often used as hedges against inflation and currency devaluation. However, their prices can be volatile, requiring careful consideration before investment. Growth of private and peer-to-peer lending. With traditional banks offering no interest, people might turn to peer-to-peer (P2P) lending platforms or private lending networks. These allow individuals to lend money directly to others for interest, bypassing traditional financial institutions. While P2P lending can be profitable, it carries risks such as loan defaults and lack of government protections. Changes in spending and saving behavior. People might save less and spend more, knowing their money isn't growing in a traditional savings account. Instead of keeping large sums of cash in banks, they may choose to invest in long-term assets or spend on experiences, education, and business ventures. This could stimulate economic growth but also increase financial instability for those without a solid savings plan. Increased reliance on government and pension funds. Without bank interest, people might rely more on government programs, employer-sponsored retirement plans, and pension funds to secure their financial future. Governments might need to adjust policies to encourage long-term saving, such as offering tax incentives for retirement contributions. Shift toward dividend-paying stocks. Some investors might prefer dividend-paying stocks, which provide regular payouts similar to interest. Companies with strong dividend histories could become more attractive, shifting investment trends toward established, profitable businesses rather than speculative stocks. Conclusion. A new era of saving. If banks stopped paying interest, individuals would need to take a more active role in managing their finances. From investing in stocks and real estate to exploring alternative assets like gold and cryptocurrencies, savers would need to adapt. While this shift could increase financial risks, it could also encourage greater financial literacy and a more diversified approach to wealth management.